Let's dig further into both tariffs and, of course, this jobs number. Joining us is Goldman Sachs' chief economist, Jan Hatzius. Good to have you here on Jobs Friday always, but in particular, give me your reaction not just to the number for July, but the revisions, of course, which we've been focused on.
Yeah, I think it's the revisions, the July payroll number, and also the household survey, which also shows quite a bit of softness. So a couple of weeks ago, we wrote a report with the title Stall Speed. You know, we had only a little more than 1% growth in GDP in the first half. And with this jobs number, I think that brings the picture to a more, clearly sort of stall speed image. I'm looking at an economy that is still growing, but it's growing very slowly. And the unemployment rate is drifting higher gradually, but I do think that the downside risks in the labor market, which Chair Powell did talk about in the press conference on Wednesday, that those are definitely there.
He talked about it not as much as he talked about the upside risk to inflation.
Well, he mentioned it, I think, 6 times that there are downside risks in the labor market.
And how many times did he mention upside risks to inflation? Probably more than that, no?
He talked about, the difficulty of making decisions when you are faced with this kind of shock, which raises inflation and lowers
But
job
does
growth.
today's jobs report change the calculus?
Well, I think it makes it even more likely that they're going to cut in September. We have had a series of 25 basis point cuts in September, October, December, and to me that seems, very likely, and it could be more. I mean, it's certainly a reasonable idea that we're in the restrictive territory, but these sort of data suggest maybe we should get back to neutral a little bit more quickly. We have that happening over a longer period of time, but you could accelerate the process.
Fed Governor Waller writes this morning, taken together, the data imply the policy rate should be around neutral, which the median FOMC participant estimates is 3%. And he says not the 1.25 to 1.5 percentage points above that. Do you agree with that?
I think it's a very reasonable case, and he also talked about stall speed in that note, and I think that's the right way to look at it. Look, I think we'll obviously learn more. This is a meaningful data release, but it's one data release, and we'll want to see what the picture looks like over the next couple of months. But if we get confirmation that things have slowed as much in the labor market, then I would say, yeah, we should get back to neutral pretty quickly.
It feels like the main debate inside the Fed and out is not whether tariffs will spark inflation. We know it's happening, in certain goods, and it might increase further. The question is, should they look through it? Is it a one-off inflation increase, or is it something that they should adjust their policy to? And that's where it feels like the dissenters feel very differently than the Fed chair and the bulk of the Fed board. So which is it?
Well, the Fed chair did say that the baseline scenario was one in which this was a one-time price increase. Now, he noted risks to that, as you point out, but he did say that was the baseline scenario. That's clearly the Waller scenario.
If that's the case, then why didn't they cut?
Because it takes a while to persuade everybody that that's the right course of action. I mean, there was never a meaningful probability of a July cut. The discussion in the committee at large has always been about September. And so, yeah, I think that's what we're looking at. And now, September, yeah, it looks very, very likely.
Jan, your team has done a lot of work on AI. I periodically ask you about it. I was just asking Sarah, though. Do you think that there is anything showing up in the data already in terms of at least the change in hiring that may be taking place as a result of the efficiencies brought to bear by enterprises adopting AI?
Yeah, I do think we're seeing early signs of it. We're seeing, for example, some weakness in technology employment over the last couple of years. Actually, as it happens, it started right around late 2022 when ChatGPT was released. We've seen a decline in technology employment as a share of overall payrolls. We've seen some weakness in the unemployment rate for young tech workers. So it is happening. So far, this is not the main thing that's driving the labor market. We're still quite a ways away from that, but we're seeing early signs.
If the Fed does start to cut in September, as you predict, and we get, what, 3 cuts this year is your prediction? I think the market's at 2. If we start to see that, is it in time to preserve what is otherwise a really healthy labor market and overall economy?
I mean, our forecast is that the economy continues to expand. We have a 30% probability of a recession over the next 12 months. So that's twice as big as the unconditional average of 15%, one recession every 7 years, but it's well below 50%. So yeah, that's my baseline. But I would note that the economy is growing at about a percentage point below potential. And the labor market numbers are now confirming that. So I do think that we're going to need to see some insurance being taken out.
And the consumer?
Well, the consumer over the last 6 months has seen no growth in real spending. And I'm expecting that to pick up a little bit. But if it doesn't pick up, that would be another very significant warning sign, because that's the sort of thing that has very rarely happened outside of recessions.
Jan, thank you.
Thank you.
Jan Hatzius, Chief Economist, Goldman Sachs.